Good morning. I hope you're all very well. Can you believe 2022 is nearly over? And good riddance, with some of the worst returns in nearly 100 years. The good news is that the pivot has finally arrived. All those positive catalysts that we've been talking about, they've arrived. Long live the pivot. And we can see that in the market returns last month. There's some really fantastic returns across various asset classes. South African equities up 9%, EU equities up 6%, Chinese equities, massive return, 18%, more than making up for the huge loss that happened in the previous month. FANG Plus up 5%, SA bonds up 4%, and the only really poor performer was dollar cash, down 6%. So November was definitely a month of risk on. The safe haven dollar collapsed, while the risky very risky and less risky equity asset classes rallied, with the most risky one, China, rallying the most. So certainly a fantastic month for the risky asset classes. And that flowed through into the fund returns as well. As you can see, the number one fund return being the Sygnia China Global Equity Fund, the China ETF up third, and the MSCI EM ETF up fifth. So EM and China dominating in the month of November, certainly recovering the value that was lost in the month of October. Longer term, if we look at 12 months, it's still the same story of value. We've got the Divi Fund there, number one, and Sygnia Life Berkshire Hathaway Fund, number two, over a 12-month period. The Sygnia Divi Index Fund is doing incredibly well. It's now to the end of November, it was the top performing fund as per the CISA general equity category. So fantastic performance from that fund, number one out of 168 funds, and zero management fee. So if you invest in the B class, you don't pay any management fee, 0% management fee. You only pay a performance fee if that fund outperforms its benchmark, which is the Swix index. So a great opportunity in terms of getting value exposure at the lowest possible cost. Certainly something that can't be ignored for too long. But let's look back at 2022. This is to the end of October, so it doesn't include the fantastic bounce we had in November when things started to come right and the catalysts and pivots started to happen. But you can see there, annualized to the end of October 2022 in the US, this is for a US balance fund, the worst return since 1930, 1931. And that's quite incredible. In nearly 100 years, the worst return. And that was predominantly driven by the very, very poor returns that happened to US bonds as a result of quantitative easing ending and quantitative tightening starting, as well as the huge inflation that came through in the US as a result of overstimulation during the COVID period, and a number of factors around that correlated, including obviously the Russia-Ukraine war and the impact that it had on energy prices and food prices. But US bonds having a terrible year in 2022, and that bringing the overall balanced fund down to its worst return in 100 years. And it wasn't just bonds and equities. Pretty much every asset class had a terrible 2022. Commodities, EM equities, defensive equities, it was all a really, really tough year with nowhere to hide. So if you or your clients are feeling like 2022 was a bad year, if you and your clients are wondering if they should be reevaluating the strategy, I think this is a very important chart to look at. When you have returns for a balanced fund that are the worst in 100 years, you need to admit that short-term performance is bad, that we're going through a unique period of time, a 1 in 100 year drought effectively for balanced fund returns. It doesn't mean that markets are broken. It doesn't mean that your investment returns are not going to happen in terms of long-term returns. It just means that we're going through some volatility. And we do think volatility is here to stay. And we do think we're in a purgatory environment for the next decade, that things aren't going to get easier, but certainly they're not going to be as bad as 1930s and as bad as 2022. And we're already seeing that bounce happening in November, some fantastic returns in November. And we do think that the year will end slightly better than we're currently seeing. So things are looking up. So let's talk about all the positive catalysts that we were expecting and the great pivots. So the first was in the UK, where we had Rishi Sunak and his team deliver their budget policy, and it was a very, very frugal, a huge pivot on Truss's economic policy, and definitely something that is going to see the UK look more stable in the long term. Definitely a very different approach, with an extra 30 billion in spending cuts and 25 billion in tax increases, which sees the UK households' largest tax burden post-World War II. So quite a massive pivot in terms of how that budget took place. But the pound has reacted nicely, pound back up to 123. And even though growth is going to be mediocre in the UK for a number of reasons, but primarily Brexit driven, this change in terms of a more sustainable economic policy is definitely well received by the markets. If we look at the EU, the worst is also behind us. We've seen that with the euro. Euro has now rallied up to 105 against the dollar from its lows of 95. And things looking good there as energy prices recede and the energy crisis comes to, if not an end, I suppose the beginning of the end. And the chart there on the right shows Netherlands natural gas prices, which have fallen 70% from their peak. And that's incredible. And it just shows that the world can move on. The world can survive. Yes, there was a short-term supply squeeze with Russia switching off their gas supplies to Europe, but markets find a way. That is, while capitalism has a lot of faults, that is one of the beauties that, when the prices are right, additional supplies come online. Germany's built 6 brand new liquid natural gas converters, and Norway and the US are now supplying more gas to the EU region than Russia ever did. So new supplies are coming online, and that's allowed prices. Yes, prices have picked up a little bit, but still way off their highs. And that means that growth can start to recover in Europe, means that the euro can stay stable. And certainly it means that we're starting to look forward in terms of European growth and not backwards in terms of the energy supply crisis. Now, I'm in no way calling the end of the Russia-Ukraine war. I think that's going to be with us for many, many, many years. I don't think there's a clean way out of that. But the important thing is that alternative supplies have been found. Certainly on the gas perspective, and even oil to some extent, alternative supplies are being brought into the EU region, and the world carries on. And although we're going to see volatility continue, and there's certainly going to be saber rattling and threats of nuclear attacks, I think we've seen the worst in this region, both the UK and the EU, and it means that markets can be more stable in these two regions at least. Now, the big pivot is, and where the word pivot comes from is around central banks and their interest rate forecasts. And that's certainly what we're seeing finally. Took a month longer than we were expecting, but finally the US FOMC and Jeremy Powell in particular, they finally are admitting that the pace in which interest rates have to go up needs to slow down. And the market's pretty much now penciled in a 50 basis point hike this month from the FOMC, 0.5%, down from 75 basis points at some point, and then possibly another 25 basis points, 0.25% next year. And along with that, the rhetoric that's coming out of the FOMC is also starting to sound more dovish. So a big pivot coming from the Fed and allowing the dollar to weaken, allowing risk markets to recover. And while this is not the end of interest rate hikes, it is certainly likely to be the end of interest rate surprises to the upside, as we've also seen inflation surprises start to roll over on the downside. So we have seen some continued, along with US CPI number, which was lower than expected. We had US core PCE, which is also lower than expected. We had US PPI, which is also lower than expected. And it's all pointing to inflation finally rolling over, to the point where, chart on the right, you've got Goldman Sachs expecting US core PCE inflation to be as low as 2.9% in a year's time, December 2023, which would be fantastic. And I've spoken over the last nearly 9 months now about all the deflationary impacts that are reaching the US, falling energy prices, falling food prices, home prices that are decelerating and falling month on month. and that all continues. But we actually are now seeing some new increased sources of deflation in the US. For the one thing, productivity in the US fell to its worst level since 1947. I mean, that's quite phenomenal. When you think that GDP growth is dependent on two things: one, the number of people who are working, and two, how productive they're working. When your productivity falls to record lows, well, that's definitely a headwind to growth. And while US growth, although it was positive in the third quarter, is certainly pretty much almost flat year on year. But that poor productivity is resulting in finally seeing some weakening of the job market, and we've seen particularly the tech sector leading the job layoff wave. And there's a hiring freeze at Amazon and Apple. Meta, they want to cut their staff by 11,000 people. Lyft and Stripe also want to lay off between 13 and 14% of their employees. So we're beginning to see that softness in employment starting to feed through, which will be deflationary as well. Payrolls have always been something that has surprised the upside, and it did last Friday. The non-farm payroll surprised the upside. Still strong employment growth, but we are starting to see the beginning of that turn, with tech sectors laying off a number of people. The other interesting new deflationary impact is the fact that the Republicans took control of the House, which is now seeing a split Congress, and that traditionally has been deflationary. It's also been good for markets. It basically means that when you've got the Senate controlling, when you've got the Democrats controlling the Senate and Republicans controlling the House, very little can be done, which means that they can't pass a whole lot of new measures which can support growth, which can be inflationary, and they also can't break anything, which is why markets quite like it. But certainly we're not going to see any huge stimulus packages coming out of Congress now that the Republicans have taken the House. So that's also deflationary going forward. And then quite an interesting surprise side effect. I mean, we're all well aware of FTX.com, and that which was valued at $32 billion as recently as April this year, now declaring bankruptcy and causing a huge knock-on effect, with a string of global firms suspending client withdrawals, including Genesis, Global Capital, Gemini, and BlockFi, which subsequently also declared bankruptcy. But what is interesting is at the peak of the crypto wave, US investors held as much crypto as they did in physical dollars. That's quite an incredible number. That in terms of dollar notes and coins that were in circulation around the US, that doubled over the last year as a result of the crypto price going up. It went up hugely. And as that crypto price has now fallen, or whatever it may be, 70%, that's obviously going to lead to the wealth effect completely reversing. So we had a huge inflation impact that we weren't even aware of as a result of crypto, which basically doubled the amount of money in the US consumers' pockets. It wasn't obviously money that was maybe some people sold, but a lot of it was not sold, and that wealth has since reversed, which will have a negative impact on inflation through the wealth effect. So bottom line is we can continue to see inflation rolling over in the US, maybe not as quickly as we want, but certainly it has peaked and it is rolling over. And that's going to allow central banks to continue to be dovish and continue to support markets. Now, most importantly here, and I have stressed it many times before, why we're not looking at the 1970s is because inflation expectations are still under control, and they remain under control. So 5-year, 10-year inflation expectations are still well within US Fed's targets, and it doesn't mean that anyone needs to panic. And as long as no one's panicking, we should be able to avoid a recession next year. In terms of recession forecast, it's pretty low from a global perspective. I think the chance of a global recession is about 10%. But it doesn't necessarily mean that various regions and countries won't go into recession. Certainly they will, but it looks like they're going to go into recession, very shallow recessions, and at different times. So Europe might go into recession while China is recovering. The US might go into recession after Europe while Europe's recovering, and all of that should keep the world as a whole just above recession level. It's still low growth, but definitely closer to a soft landing and a mild recession, certainly not a hard recession, which again is positive for markets and for next year. The other huge pivot we saw was in geopolitics. Part of the reason that Chinese markets sold off so massively in October was concerns about the US tech Cold War, China invading Taiwan, and all sorts of things that might happen as a result of Xi extending his term to a third term. And then we had the G20 summit in Bali on the 14th of November, and here you can see Xi Jinping and Biden shaking hands and talking about elevating the relationship. Now, I know a lot of this is posturing. It doesn't necessarily mean that everything is fixed, but certainly it does mean that things aren't going to go to World War III overnight. And this pivot into a more, at least amicable in the short term stance between the US and China is helping. It doesn't mean that the tech Cold War has gone away by any extent, and certainly China remains, it's always been our most volatile region, and it will remain a volatile region. But Xi Jinping's also met with leaders from 25 countries since he's extended his started his third term, and he seems to be making a concerted effort to work diplomacy into his policy. But more importantly than that, we also saw two massive pivots in China in terms of reform. The zero tolerance COVID policy, a 20-point playbook was released to reduce the economic impact of COVID on the economy, basically to try and reduce the lockdowns. And this came shortly before a huge amount of social unrest in China. We saw protests that we haven't seen for decades in China. And certainly the world is looking on with massive concern. Would this be a repeat of Tiananmen Square? It's the biggest threat to Xi's leadership in his 3 terms. How would he react? What would happen? And it seems, fortunately, that not only have we had this 20-point playbook and new relaxed COVID policy, but she's taken a more conciliatory and reasonable response to the protests, and using local municipalities as a scapegoat, and saying that local municipalities, yes, the central government put together this COVID policy, but they delegated the implementation to local municipalities, and they were certainly too strict. And the central government has now issued a number of directives that municipalities must rein in their lockdown measures and only do it according to the policy. And we've seen a spate of reductions in lockdowns across China and increased mobility as a result, and that's helped Chinese stocks recover significantly. At the same time, the property sector was in the doldrums, one of the biggest drivers of growth in China, and that it pretty much ground to a halt because of a lack of liquidity. And we saw a new policy, again, a 16-point playbook, which is addressed at creating liquidity for developers. And a whole lot of measures, but some very, very, very powerful measures that have been rolled out that will allow developers to access cash, such as cash in escrow accounts. And we've seen that property sector start to recover. And yes, it doesn't mean that the long-term prognosis is great, but at least in the short term, they can start to complete the housing jobs that are under development. And that will allow the cycle to restart, which is fantastic. Longer term, in terms of the big picture for China, Chinese inflation remains low, 2.1%. China and Japan both have avoided this massive inflation that we've seen in Europe and the UK and the US, and that allows them to keep stimulus strong. That's why Japan hasn't seen any interest rate increases, and why China has been able to cut the reserve rate requirement again. You can see there that reserve rate requirement has been cut by 25 points down to 8%. It's after peaking above 20% in less than a decade ago. So certainly room for a lot of stimulus due to lower inflation. And we do believe that China remains too big to ignore. Yes, it is risky, certainly. Yes, it is volatile, certainly. But 80% of countries around the world trade more with China than they do with the US. And that partly talks to the fact the US is so insular, and only 10 to 50% of US GDP is based on derived from imports and exports. So are very much an island. But still, it means that if 80% of countries around the world trade more with China than the US, China can't be ignored. China can't be something that can just be swept under the rug. It is something that we have to keep our eyes on, and we do. And we do think it's part of a long-term investment strategy, even if it is a smaller exposure than originally thought. We have used the massive bounce that we've seen in markets. I mean, South African markets were up 13, 14% over the last 5 weeks. China up nearly 40% over the last couple of weeks. And we have used that bounce to reduce some of our risk. We were expecting a positive bounce as a result of all these catalysts, all these pivots. We've seen that, and we have used that to lock in some of the bounce, some of these gains, and it is working well for our portfolios. So the one place, as usual, where we haven't seen a positive pivot or a positive catalyst is South Africa. In fact, we narrowly escaped the resignation of President Ramaphosa after the release of the recent report into the farm scandal. And here we've got Finance Minister Godwana talking about Cyril, saying he is more important than the party. My prayer for now is that he remains. And unfortunately, when it comes to investing in South Africa, that has to be part of your strategy. You have to rely on prayer. There's not much else that you can rely on. While strategy is always really good in South Africa, and while we always know exactly what to do, execution seems to be based more on prayer and hope than on anything else. So it is why we remain underweight South African equities. But we do think that despite the Phala inquiry, that President Ramaphosa is likely to retain his presidency at the ANC elective conference this month. Yes, it has given more power to his opponents, and it does mean that he's likely to get less allies in the NEC that he was hoping to get. It does mean that probably means slower reforms going forward, but probably more of the same as we've had over the last couple of years, as opposed to any worse, but unfortunately not better like we were hoping that it could be. But the big issue for South Africa, as we're all very, very, very well aware, is load shedding, something that's now part of daily lives. It's not a matter of if, but just how bad it is on a day-to-day basis. We've seen record power outages. We've also seen Eskom run out of diesel. That's why the open gas cycle turbines aren't running. And central government has said they don't have the budget to provide more money for diesel. So this is likely to continue. And unfortunately, with load shedding, it's a drain on investor confidence. It's a drain on foreign confidence. It's a drain on investment, which means it's a drain on job creation, a drain on the economy. And it's a very, very, very disappointing and tragic event. And it is why unemployment stays so high. Yes, unemployment did tick down slightly to 32.9%, but it remains the third highest in the world, with only Angola and Namibia ahead of us. It's very, very, very sad. Inflation also remains pretty muted because of the low growth of core inflation, still very much within the SARB bands. But despite that, the SARB did raise interest rates by 75 basis points to 7%. Markets are pricing in another 75 basis points over the next 6 months. I can't see that happening. And obviously, it all depends on what happens to the rand, what happens to the US rates. But we're now looking at a real repo that's nearly 2% on core inflation. And with our growth so low, we really can't justify having interest rates too much higher. It does mean great yields though. So we are seeing some fantastic yields. We are overweight South African bonds when you've got a yield of nearly 11%, and we are overweight South African credit. We've been topping up our credit exposure as interest rates have increased, and our credit funds got an exposure, a current yield of nearly 10%. So when you're getting 10% on credit and 11% on bonds in such a low growth environment, well, it's hard to ignore, and it's why we do remain overweight South African bonds and underweight South African equities. Yes, I'm very well aware of the fact that there is a negative catalyst coming up. We do have the grey listing in February. It's practically a certainty, 100% chance it's going to happen, which means the markets have had a chance to price it in. I think there might be a knee-jerk reaction when that happens, but I think bond markets are pricing in most of the risk in terms of the cushion between US bonds and South African bonds. That cushion has widened. And certainly leaves room for some negative events to happen. So we remain overweight South African bonds, and they did have a great month in November, but unfortunately December, with the risk that President Ramaphosa was going to resign, we gave up a lot of those gains. But again, it's a bit like China. We are going to see a lot of volatility in South Africa, in the rand, in the bonds, but when your running yield is so high, well, you get paid to hold the position. So we believe it is worth holding on to. So that brings me to positioning, and it really is all about, as I've said before, all about the dollar and growth. And it is a circular reference, unfortunately. So it's hard to tell whether it's the chicken or the egg. And does a weak dollar cause the rest of the world growth, or does rest of the world growth, ex-US growth, cause a weak dollar? I think it's a bit of both. So we have both the chicken and the egg. But when the dollar is at its most overvalued since the 1970s, well, certainly the dollar is facing some headwinds. And with China, huge reforms coming through on the COVID policy and on the property sector, Chinese growth recovering, that will support rest of world growth. So we're going to have weaker dollar as a driver, and at the same time stronger rest of world growth as a driver, and that's going to, both of them will help each other. So that China's growth recovery will help the dollar weaken, which in turn will help the rest of the world growth. So we'll see some positive spirals coming through, reinforcing cycles, which is great. Chart on the right there just shows what BCA in terms of a stylized forecast for the dollar. You can see there how expensive the dollar has been. They're saying the dollar is only going to get worse in a hard landing scenario. We definitely aren't forecasting a hard landing scenario. We're forecasting somewhere between a mild recession and a soft landing. So definitely a softer dollar, and correspondingly positive returns from other asset classes. Doesn't mean volatility is not going to go away. We certainly are expecting volatility. Markets have had a very, very strong November, so it would be only natural when markets have rallied 10% for them to give up some of that before they go further. So yes, there is going to be some volatility. Inflation risks remain, but we do think that we are through the worst at a global level from what we've seen in 2022. We remain underweight the US and overweight our global equity themes. We remain overweight US value, and we remain overweight South African bonds. And generally, with a recovering global economy and anchored long-term inflation expectations, we do think that markets will move up rather than down over the next 12 months. In terms of the global themes, so I've just reworked this slide slightly just to talk about why we do think it's important to invest in global in themes globally. Now, the background to our entire investment strategy is the fact that we're on a low growth, high volatility world. We updated our strategic asset allocation 4 years ago to acknowledge the fact that returns are going to be lower, volatility was going to be higher, and that's played out perfectly. So we reduced or removed South African property, which worked very well. We added in South African credit, which is far more stable, and that worked very well. We took more assets offshore, which also worked very well because the rand is a fantastic stabilizer, but also because having more offshore allows us to get exposure to our growth themes. So we have 4 reasons why we think, while we thought 4 years ago, why growth is going to be low, and why we think growth will remain low over the next decade. And we've also got 4 opportunities where we think that you can benefit. So every headwind has the balancing opportunity, and we've tried to use those problems to find solutions. So the first of the Ds, which we've spoken about, is decarbonization. And certainly is a headwind to many of the traditional businesses. It's a tax on many businesses, whether it's a direct carbon tax or whether it's people being forced to price in the indirect environmental impacts of their manufacturing processes or the mining processes. Either way, it's a tax on traditional old businesses. So you invest in a sustainable economy theme, which looks at companies that are directly providing services, products, and opportunities that will fight climate change, that will help make tomorrow better. So whether it's new irrigation systems or solar panels or new grid distribution systems, it's new market shares and certainly new companies that are finding that they have got tailwinds. And I'm sure many of you, if you look at in South Africa as a microcosm, certainly in Cape Town 3 years ago, every single truck you saw on the road was a borehole company or a well point company. Now every second bucky you see on the road is a solar bucky, and they're putting it onto your roof. So definitely, while decarbonization is a growth headwind, the sustainable economy will benefit from that, and there certainly are a niche sector that will benefit from the slowdown in growth and profits from the old sector economies. Deglobalization is also another growth headwind. We've seen that a result of the US trade wars on China that then fed through into the Ukraine-Russia war. Supply chains was destabilized, and at the same time, with low growth, a lot of countries are looking at nationalism. It's all about onshoring. It's all about supporting local employment. And that means that global companies are becoming less global. So you can no longer rely on big global companies to give you exposure to China if you want it, or exposure to India if you want it, because everyone's looking within. And that's why it's important that you have this theme which looks at emerging consumer. For us, we think that the next billion emerging consumers is Asia ex-Japan, which includes China and India. While deglobalization headwind is a headwind to traditional growth and traditional profits and companies, you can still get exposure to those growth countries through a specific theme. Now, debt is one of the oldest ones that we've had in terms of our growth headwinds. That used to be our biggest headwind to growth. Certainly, it wasn't a big one over the last few years because interest rates were so low. But now, finally, interest rates are normalizing, and companies are seeing a huge knock on their income statement, as all of a sudden they have to pay a massive interest bill, not because their debt levels have gone up hugely over the last year, but because interest rates have gone from 0 or even negative to 3-4%. And that means that profits are lower, which means that growth is lower. It means that companies are going to employ less people. It means that companies are going to spend less on research and development. And that is a direct correlation with why we invest in our 4th IR fund, disruptive technologies. If existing businesses don't have the budget for R&D, well, you need to look at new companies that are focusing on new sectors. So while the growth as a whole slows and traditional businesses slow, well, yes, you've still got new market shares being created, and those companies will grow even when the world is slowing. And finally, demographics, which is led by aging populations, and that means that you've got fewer people in the workforce and more people who are retired. And that means that you've got lower growth directly, because growth is made up of the number of people working and how productively they're working. So that's a headwind to growth. At the same time, it's a boon to healthcare stocks, because not only are there more people who are older, but they are wealthier, and there's also new therapies that are coming out all the time. So health innovation is the balancing factor. So from a global perspective, it's why we do like to invest in the core satellite process. We have our core, which invests in the large indices, MSCI World and S&P 1200 Global. And then we've got our satellites that will provide growth in a low growth, high volatility world. And that remains core to our investment process going forward. Now, we have just updated our strategic asset allocation, so I think it's important to talk about this slide. It doesn't have a huge impact on the funds themselves because we have tactically, since regulations changed about a year ago, we've tactically been moving money offshore. We took a large chunk offshore earlier this year, and the rand was at 14.5. Ironically, we actually right now, we've been bringing a little bit back. When we were at 18, the rand was at 18, and we're putting on some currency hedges. But we have now finally adjusted our strategic asset allocation, basically moving our SAA to our TAA, or we're bringing our long-term benchmarks in line with the funds are. And why have we done that? Well, the primary reason for refreshing the SAA has been the dollar strength. So while we continually review our strategic asset allocation, while we continue to review our benchmark, it's something that we changed once 4 years ago, and we are changing now primarily because of the dollar. So when the dollar reaches 50-year highs, it has to impact your 5-10-year outlook, and it has. So we've got slight dollar weakness over the next 5 years, and so that impacted our return expectations. At the same time, given the fact we're finally seeing inflation and interest rates are no longer zero, it's the first time really since the great financial crisis nearly 14 years ago. So we have adjusted for higher bond yields and higher cash yields. At the same time, we've also structurally downweighted South African growth, not hugely, but slightly. And we also acknowledge that the fact that valuations are looking quite reasonable around the world. So those all impacted our real return expectations, and they had a number of impacts. One was obviously to increase our offshore. So we have increased our offshore from 28% to 33%, or 33 to 35%, depending on the funds. But that's where the funds were sitting anyway. So it isn't a change to where the funds are, it's just a change to our SAA. So SAA is our benchmark, and it's our risk process. So it's very important for us to use it as a starting point, but it doesn't mean the funds will change overnight when we change the SAA. The other thing that we did do is we reduced the exposure to global bonds and global cash. Dollar cash has to come down because we are expecting the dollar to weaken. And likewise, global bonds are going to come down because we think that the dollar is going to weaken slightly as well, despite higher yields. And instead, we've allocated in our SAA for the first time a global alternatives. We have had in the funds for 3 years now. We've had global alternatives. They haven't been in the SAA, so that's just bringing that into the SAA, and it just completes the portfolio. Now, a number of you are going to be asking, why aren't you sitting at 45% offshore? Surely that's where we should be. South Africa is broken; it's a failed state. What's the deal? The deal is that when we model this, so let me just step back. Sorry if it's a bit technical, but the way we model this is by putting in our expected return. So that's inflation plus target. We want real returns of 3% or 4% or 5%, depending on your risk profile, but because these are long-term investments. Generally, when you want to invest for the long term, and you want to beat inflation. So given that's your return target, inflation plus 4%, for example, we want to find the most robust portfolio to give you that return. So not the highest return portfolio, the most robust. So which portfolio will most consistently give you that return? And we run literally millions of optimizations, which uses historical risk, because risk tends to be quite consistent going forward in our forward-looking return assumptions, and it all gets put together in a model, and we look for the portfolio gives you the most consistent returns. So when you're trying to consistently match inflation plus 4%, the model doesn't like having too much offshore, because if you can have periods, it's hard to believe right now, but there have been periods when the rand has strengthened for 2 years in a row. And the rand has strengthened 30% at points. So if you have half your fund offshore, and that is doing minus 30%, well, as you can imagine, you're not going to be consistently getting your inflation plus target. And if you are getting closer to retirement, you don't want that sudden 30% drawdown. So part of it is acknowledging that we have rand liabilities. It doesn't mean we won't take more offshore in future, but the other part is that South African equities are historically very, very cheap. Yes, there are reasons for that, but even adjusting for the structural headwinds in South Africa, South African equities and South African bonds are very, very cheap, and that's why we don't have more offshore. With South African bonds giving you some of the highest real yields in the world, it's certainly more attractive having your credit and your bonds locally rather than offshore, and this is why we're not sitting with a higher offshore allocation. So that's wrap. That's the update to our SAA. As I said, no update to the actual portfolios, just bringing our risk benchmark in line with what the portfolios are doing, and driven by change in our long-term assumptions. Let's have a look at some questions. Last Q&A for the year. So Patrick asks which funds are going to increase their allocations offshore. So all our funds have the same global equity exposure, but in terms of global exposure, we do have higher global exposure for the higher risk funds because, as I mentioned, the more you have offshore, the more volatility you have when the rand strengthens. So our higher risk funds, such as Skeleton 70 and CPI +6, and Signature 70 and Skeleton Balance 70, they have between 33 and 35% offshore. We're not going to 45% just yet because of value in SA bonds and value in SA equities. Sean asks if Facebook is an obvious buy. Sean, there's a lot of debate, particularly on the FANG stocks going on within our team. Value, those FANG stocks, whether it's Amazon or Apple or Facebook, have never looked so cheap. That they used to be growth stocks, they're now value stocks. They're also seen as quality stocks because they've got such high cash flows. So they are ticking a lot of boxes. But at the same time, we still don't have any exposure to the FANG portfolio in our balanced funds. Despite them being fantastic companies with great moats and great long-term expectations, in the short term, I still think there's some headwinds. And the major concern is just margins. Those FANG stocks have record margins, and as antitrust legislation is put into place, and as competition increases in the US, we do think that margins are going to come down in the big players. Now, it doesn't mean that returns are going to be negative. It just means that they are going to not grow as fast as they used to grow. And I don't think they're priced cheap enough yet for that low growth. So we aren't buying the FANG stocks yet. That said, we still, because our largest exposure in our global equities is the US. US equities make up half of our global equity exposure. It means by default, by holding the index, we do have big exposure to those FANG stocks. They're probably the biggest stocks in our funds as a result of their index weights. So it doesn't mean that we're selling them, but we're also not buying them. Alex asks if now is a good time to be getting invested in some of the Sygnia funds, despite the great bounce we've had in November. So, Alex, as I mentioned, we have been trimming some of our risks. So we were buying at the lows of September and October, and those buys we have taken profits on. We have banked those gains, but we still think that long term, that these themes do show good value, and we still are overweight all our themes. Besides FANG, we are overweight 4R, we are overweight healthcare, we are overweight emerging markets in China, we are overweight value, and we are overweight sustainability. So we from a long-term perspective, we think they all are great buys. And the best way is if you do have cash, is to just trickle that cash in and average your entry points. So as I said, volatility is going to continue, which is why I think you should average it. And we have quite a strong bounce, but I think that's still a good entry level. So it sounds like pretty much a hedged view. It is a hedged view. I don't have a crystal ball, so the safest thing to do is just to average it in. Anton asks why healthcare and 4R is still negative. Healthcare, I'm pretty sure, is positive. In fact, it's the healthcare has the best returns year to date and is positive in rand terms. Fourth R is, Fourth R has it's probably the worst performing fund year to date besides FANG, but of the themes that we hold. Fourth R is actually worse than China. Can you believe it? So despite all the risk and all the concerns that people have about China, Fourth R is underperforming China. And that's driven by the fact that US small caps are being unloved right now, and US tech is unloved right now. But as we get closer and closer to US inflation, US interest rates peaking, we do think that both US small caps and US tech stocks will recover, and we particularly do like Fourth R. George asks, will the slides and recording be made available? Yes, George, they will be. And we do have a Sygnia YouTube channel. So please have a look at our Sygnia YouTube channel. It has all of the previous webinars, as well as product-specific webinars and other webinars that we put out. It's a great channel. So please have a look there to see what else is available. So what does grey listing mean for the average SA citizen? John, it depends if you want to take money offshore. What it means is if you want to take money offshore directly, in terms of KYC, it's just going to become a lot more difficult. In terms of the paperwork, it's just a lot more difficult. You're going to have to do, instead of sending just proof of address, it's going to have to be a certified, and there are going to be a lot more hurdles to jump through in terms of opening up offshore accounts, taking money offshore. Just dealing offshore is going to be a lot more difficult. So that's the impact. I think even people who are currently have money offshore, they're going to have to probably re-FICA themselves or re-KYC themselves. So it's just a lot more red tape, a lot more bureaucracy, a lot more admin headaches. Mervyn asks, if yields for bonds are so great at 11%, why is the performance so low? So that's because, well, so Sygnia enhanced income is not. The Sygnia enhanced income return is fantastic, and that's because Sygnia enhanced income is primarily credit, and it is far more stable. The Sygnia bond fund, yes, although it's had 10% yield over the last year, it's also had 5 or 6% a negative capital impact as yields rose, the capital price fell, and that's why bond returns have probably been 4%, I think, over the last year. But you have to balance the capital returns and the yields on SA bonds. If you're just investing in SA bonds for the yield, if you don't need to sell those bonds, then you are earning 11% and you can spend that 11%. As long as you don't touch your capital, just spend the yield, then you are earning the full 11%. You don't have to worry about capital fluctuations because that capital will come right. You don't need to touch it. Alex asks, which specific Sygnia funds would I recommend? And as I've said, we are overweight all of our themes right now. Okay, Tom asks a great question. He says, why can't global equity indices fall lower? Why can't they fall lower than the lows we saw in 2022? He says the idea that growth just keeps going up. Surely we're in a different cycle. There's a pandemic, there's war, there's inflation, quantitative tightening, geopolitics, the 4 Ds that I talk about. So he says, why do we think that markets can keep going up? That is a great question, and certainly the outlook for 2023 is the most negative I've seen it. I think there's been a lot of capitulation from strategists. A lot of them are saying that volatility is going to be high, that there are going to be some steep pullbacks because of all the risks that you've mentioned. So how do I counter that? Well, generally markets tend to climb a wall of worry. So that's the first point. The second is that there is a lot of idiosyncratic risk going on right now. So yes, while there are issues in various regions, and they're not a global driver. So each region is having its own issues, and they're sort of crawling through their own issues at different times, which will help support growth generally. But I think most importantly, and this is what we did 4 years ago when we adjusted our SAA, and what we've just done now is that we used to forecast equity returns like this and bond returns way down. And we've reduced our equity returns quite a lot to acknowledge lower growth. And we haven't reduced our bond returns that much. But it does still mean that to get a long-term real return, you have to be invested in equities. Yes, it's going to be more volatile. Yes, it's going to be lower than it has historically been over the last 40 years. But equities are still going to give you better returns than bonds over the long term. So while that differential between equities and bonds is narrowed, and while bonds give you a far better risk return outlook, you still need equities to get that real return. In fact, you probably need more equities just because those returns are so much lower. So the tricky thing is, yes, markets aren't really as attractive as they've ever been, but they're not great. Yes, returns from equities are probably the lowest they've ever been in terms of being forecast, but you still have to have them if you want to beat inflation over the long term. And as I mentioned many times, we are in a purgatory environment. We had 40 years of fantastic returns from the early 80s to maybe it's 30 years of great returns, from the early 80s to the late 2000s. 35 years, and we had interest rates go from 16% in the US to 0. Now, US interest rates are the cost of global money. The more costs to borrow, the more costs to hold an asset. So we had 35 years of fantastic returns where interest rates went from 16% to 0. And people just borrowed, and they borrowed, and they borrowed. They spent money they didn't have, and the cost of borrowing kept going down, and people just kept buying more equities and more bonds and more houses and gold. And it really was the most amazing time to have invested, to be invested, to have owned any asset. And that's why there's a huge dispersion in terms of boomer wealth and millennial wealth, because that all those assets have revalued as interest rates went down. Now, best case scenario is interest rates move sideways. I don't think they can go too much higher because there's so much debt, but we're now sit in this purgatory environment where interest rates are lowish. They're not going to go too much higher, but they're going to be volatile, and they can't go any lower. So your best case scenario is that you earn the income from your assets. You get small capital growth from equities. I mean, the last 35 years, bonds gave you as much capital growth as equities. I mean, it was fantastic. You held bonds for capital growth. You held, it was quite a phenomenal environment. That's no longer. Now it's all about income. You need income to be able to retire, to be able to live off your investment. Fortunately, income levels have gone up slightly as interest rates have gone up, which makes it a little bit easier to retire, but your capital expectations are going down. So you need to rely on your income a lot more. And that's why value is actually doing very, very well, and is likely to carry on doing well, because dividends are going to be so much more important going forward in a low growth environment where capital returns are so much lower than they were in the past. And that's why bonds remain attractive. But unfortunately, you do need those real returns. You do need some capital growth. And even though equities aren't very attractive, they're still the best option besides alternatives. And that's obviously why we have added in alternatives. We like our themes. Our themes are effectively listed alternatives. So we do have our themes, which we do think will grow a bit better and will give you better capital returns in the market. And we have our unlisted alternatives, such as OSC and Bravos, which we also think will give you better returns in the market. So you have to look at alternatives and to try and beat the low growth environment, but you unfortunately can't get rid of equities. Thanks, Renee. Bruno asked about US bond yields, attractive relative to historical levels. Yes, certainly US bond yields are looking attractive. They definitely are looking attractive. Global bond yields are looking more attractive than they have been in a long time. But we still still, in fact, as you saw, we down-weighted our expectations for US bond yields. Part of that was the fact that dollar is going to weaken a bit, but also I do think that US bond yields are going to stay, probably going to climb higher over the next 12 months, not nearly as fast as they have over the previous 12 months, but we're not expecting great returns from US bonds at this point in time. We still think that there's still some QT, quantitative tightening, that needs to finish before bonds work properly as a risk protection asset class. As we saw this year, they didn't provide any protection when markets fell, and although they're getting better, there's still some QT that needs to be unwound. Jean asks how our fourth IR fund compares to the ARC Innovation Fund. Very different. The ARC Innovation Fund is very concentrated, probably 40 or 50 holdings. Fourth Industrial Fund has 600 holdings. ARC is very concentrated in its themes. Fourth IR has 26 themes that it invests in. So you get a much more diversified return in Fourth IR, much less volatility, and a much wider exposure. So we've launched a separate sustainable economy ETF, but those new indices that make up part of that sustainable economy ETF have been added to the Fourth Industrial Fund as well. So they make up a much smaller exposure, but we continue adding new themes and new indices to Fourth IR, and so the fund keeps on finding new avenues of growth, new industries that are growing, and is certainly very different to ARC. It never got to the euphoric levels that ARC got to during the COVID, but it also didn't fall as much. It fell about half as much as the ARC Innovation Fund fell. So we certainly like it, and obviously it's cheaper. So it's a big reason to like it. Naval asks, what's my take on Twitter and its future strategy? Yeah, that's a great question. I think we're going to have a webinar on that on its own, and try and understand the mind that is Elon Musk. Certainly something I can't answer in 2 minutes. John asks, which income funds use the most South African bonds? So our enhanced income fund practically has no exposure to bonds. Our income maximizer fund right now has about 80% exposure to bonds. We are reducing that slightly as credit becomes more attractive, but we still think there's some capital gains to come. So that's if you want to buy bonds directly through the Sygnia All Bond Income Fund, or the Sygnia Enhanced Bond Income Unit Trust, or on the life side, Income Maximizer, which gives you the best of bonds and credit. Bruno asks a great question. Crypto assets now recognized and regulated, Reg 28 restrictions notwithstanding, is there a place for Bitcoin in a low return environment? If so, at what allocation? So crypto assets aren't actually, they're recognized, but they aren't regulated. It's a bit of a funny situation we find ourselves in. We still can't add crypto assets to any of our funds, despite them being recognized. So no, we can't really put them into other funds. In terms of the outlook, again, it's been a fantastic debate within our team. We've got some diehards who are concerned about the credit risk that exchanges offer, and they've all taken their money off exchange and put it into their wallets, and waiting for more stable times to return. I think definitely over the next year to two, there's going to be some hard times for crypto assets, just as there's a rebalancing. I think the credit risk of exchanges wasn't fully appreciated. People didn't realize that they could lose their money if the exchanges went bankrupt. And so that has to feed into the system. It's going to lead to a lot more selling, people selling the bounce as the bounce happens. But it doesn't mean, I don't think crypto is dead by any regards. I think that decentralized exchanges are probably going to come to the fore, using smart contracts and Ethereum, Web 3.0, whatever you want to call it. I do think that's going to save crypto, but it is going to take a while. So I think we're in for probably 2 years of again sideways, some uncertainty until there's a stronger understanding and adoption of decentralized exchanges.
I mean, if you think about it, the whole point of crypto was that it's decentralized, and yet you're buying your crypto on a centralized exchange. So it in hindsight, it was hindsight 2020. In hindsight, it did seem rather odd. So we can't put them in the funds. We wouldn't if we could for the next year or two. Certainly, if you hold it, I'm sure the holders are holding. But we think that there's probably still need to get all this uncertainty out in terms of the credit risk and people's funds being halted as a best case scenario. A great question. Do you think if Ramaphosa resigns, it will destabilize the market? Well, I think the market answered that. When there were rumors that Ramaphosa was resigning, the rand lost literally a rand. I went from 1690 to 1798 intraday on a rumor that he was resigning. So certainly the market is terrified of his resignation. But I think right now, it looks like again, if you listen to the ANC, a very small chance that he's going to resign, less than 10%, and certainly a 90% chance that he will remain our president. So I think that the outlook in general is not as good as it was going to be. I think that the NEC is not going to be filled with as many supporters as Cyril would like, but I don't think he's going to resign. We're going to ask about SA listed property. We remain. It's still not part of our SAA, as I've mentioned. Our strategic asset allocation. It is looking cheap. There are decent yields, but I still think that that there are some headwinds. So right now we prefer SA bonds, I suppose. So the income maximizer can choose between property and bonds and credit. We don't have any property right now. I just do think that there are some growth risks. A lot of the risks have been priced in, but I do think that there's some growth risks that remain in that sector. Yes, very cheap. Yes, great yields. I think you've got a long-term time horizon, probably not a bad entry point, but short-term, I think still more certainty, if not more upside from SA bonds. Diane asked if it's worth considering buying a Chinese ETF at this stage. Diane, it's important to consider buying anything, but I would again use this, my usual out and just say be diversified. And we like all our themes, our 5 themes, and we think it's important to balance the themes against each other. So have some value, have some growth, have some China, have some US, have some small cap tech, and it's important to have all of them because they all do work at different times, and having a stable returns is very important. Mervyn asks, is there China in 4th R? 4th R has no China. FANG does have China. Bradley asks, if you take up the charts, are you not concerned about another Great Depression? So Bradley, I think you've hit the nail on the head there as to why I believe we're in purgatory. So the only reason we are in purgatory right now and not going through a massive bull market is because when we hit the great financial crisis in 2008, we didn't have a Great Depression. Central banks stepped in, they used QE, and they took interest rates to zero, and they kicked the can down the road. So right now we're in purgatory. We're going to be in purgatory for the next decade because central banks have avoided a Great Depression. They've kicked the can down the road, and we basically said, okay, you can clear out the system, you can have creative destruction, you can have huge unemployment. Let's go into depression in 2008, 2009, and then rebuild. But they didn't want that. They didn't want to lose the jobs. They didn't want to be voted out. And so they took possibly the right decision, certainly the easier decision of bailing everybody out. But we're now paying for that 20 years later, 14 years later, but we will be paying for it for the next 10 years. And that's why we are in a low growth, low return environment, because we didn't go through a Great Depression. And it's why we're not going to go through another Great Depression, because central banks will bail us out. So we are stuck in this purgatory environment of low growth, of high volatility, and we're going to be stuck in it. We don't have enough growth to get out of it, pay down our debt, but we have enough populist governments and central banks that won't allow us to clear out the route and get rid of these companies that are not making any profits. Sean asks, surely themes play out over longer periods than sector tilts? But Sean, that's actually a very interesting question. Yes, so we invest per theme, but we manage our risk per sector and per geography. So yeah, it's a bit of a nuance. It's a great question. So we do think that themes will win in terms of a return perspective of the long term, but we also are very cognizant of geographic risks and sector risks. And that's why we don't have massive exposure to any of our themes, because we are cognizant of either tech risk, US tech risk, or US small cap risk, or China geographic risk, or other risks that may come through as a result of those themes. Too much growth exposure versus value. So yes, we do monitor those risks in terms of compiling the overall portfolio. James asks, is a 60-40 equity bond portfolio allocation still valid? It definitely depends on your risk levels. If you're a long-term investor, you probably want more equities. If you're a short-term investor, slightly less equities. Also asks, again, an interesting question. If I switch out of the individual thematic funds into the Skeleton International Fund of Funds, will I invest in the same thematic funds? Yes, you will. So it all depends on the ratio. So all our global equity funds have 80% core, 80% core, and 20% themes. So we don't, roughly you could say we've got 20% in themes and we've got 5 themes, so roughly 4% to each theme. Not quite that, because we do over and underweight themes as we go over time to manage risk, but that's roughly that. So if you have 80 Rand in the SIG World ETF and you have 20 Rand in our thematic ETFs, and you sell those and you buy Skeleton International Equity Fund of Funds, you'll be getting the same exposure. And then we'll manage the themes for you. Jean asks, what percentage of decisions on 4th R is still being made by Kensho? All of it. We are reliant on Kensho. We do work with Kensho, but we're reliant on Kensho for those themes. Tom says, have a Merry Christmas and Happy New Year. And I repeat that to him and to everybody. Thank you very much for tuning in, everybody. Thank you very much for joining me over the year and supporting Sygnia. I really hope that you do have a fantastic holiday season, and that markets stay buoyant and keep you happy, and that next year is much easier than it was this year. So thank you, everybody, for joining. Hope you have a great holiday season.